Continuing with Chapter 5, we're going to go into the second module of Learning Objective 2. And here we want to look at the accounting for the purchases of merchandise under a perpetual inventory system. We'll also take this opportunity or take this module and use it to explain the different types of inventory systems. There are really two approaches to account for inventory. One is perpetual, the other is periodic. And typically, in a periodic system, purchases for the period are recorded in a separate purchases account, and they're added to beginning inventory to arrive at an interim total, which is called the cost of goods available for sale. Then, the ending inventory is determined by a physical count, and when you subtract the ending inventory from the cost of goods available for sale, you get the cost of goods sold. Now, this computation is needed in order to determine the cost of goods sold for the period. Now, what makes this, I guess, somewhat unrealistic is that you don't have any information about your ending inventory or your cost of goods sold until the end of the period. So let's take a look at an example, and these numbers, of course, are assumed. And let's start the year with a $5,000 beginning inventory, and that, of course, the ending inventory of the prior year is the beginning inventory of this year. And then we go out and we buy some inventory, and these are, of course, merchandise inventory. We're talking periodic. So the purchases are added, and we come up with something known as the cost of goods available for sale. In a periodic system, there's a separate account called purchases. And this is a temporary account. And when you buy the inventory, the purchases go into a separate account, and the beginning inventory, or the inventory account itself of $5,000, is not affected by the purchases. So they're separate accounts. And basically, you don't know what's going to be in the inventory, and this should actually just be the inventory account. So you don't know what's in this inventory account until you take a physical count at the end of the year. When you add the cost of goods purchases to the beginning inventory, you get something called cost of goods available for sale. Then you take a count of the inventory, it's valued, subtract ending inventory of $4,100 from the cost of goods available for sale, and you get the cost of goods sold. Now again, the problem with a perpetual system is that the ending inventory is not known, cost of goods sold is not known, and of course your profit margin for the period is an unknown until you take this physical inventory. And this is the cost of goods sold formula used in a periodic inventory system. So obviously, as I was saying a couple of seconds ago, a pure periodic system is really unrealistic. It's impractical for a large company because a business really can't wait until the end of the period when they take the physical count of inventory to keep track of the ending inventory and the cost of goods sold and your gross profit margin. And of course, the periodic inventory is very inexpensive and an easier way to take inventory or manage inventory for a small business, but it's certainly not an effective way to manage a large inventory for a significant or large corporation. So to summarize, in a periodic inventory system, you would have the physical count is required to come up with your ending inventory. Usually you might want to use this for inventory that is not of high value and for a company that does not have an ability to scan the barcodes or scan the inventory. And of course, computer technology makes the periodic system less and less popular in practice. Okay, so periodic is probably going to be used for companies with very inexpensive or immaterial inventories, and for companies that small enough where you would not have a scanner. Now, the perpetual system is what we're going to focus on because it is more realistic, used in supply chain and inventory management. So it's much more widespread. The perpetual inventory system allows for real-time updates of inventory balances and cost of goods sold. And at any point in time, every day, you could determine the ending inventory, cost of goods sold, and the gross profit margin can be determined after each sale. You don't need to wait for a physical count. Now, under a perpetual system, we continually update our acquisitions and sales of inventory, cost of goods sold. As I said, the gross profit margin could also be determined at each point. And the continuous monitoring of sales, cost of goods sold, gross profit, the inventory balance allows us for a much better management of our inventory system and our cash flows. Remember, we said in a previous module that if too much inventory is tied up in cash or tied up in inventory, that cash is tied up if it is unsold inventory. The cash is also going to be tied up if you don't have a good collection of your receivables. But just staying with the inventory right now, unsaleable or obsolete inventory is going to be a problem because cash is tied up and it will stall the cash operating cycle. So you need a perpetual system to help monitor the inventory or manage inventory and ensure a very rapid turnover of inventory and collection of receivables. So to summarize, a perpetual system. A perpetual system is going to track every inflow and outflow of inventory in real time, as I said, and merchandising and purchase systems are integrated. And of course, obviously, you could scan items that come in, and when you sell the inventory, it's automatically updated because the cash register will scan the products that are sold. So, and I think you've experienced this yourself, you go into any retail store, a salesperson or a sales associate could immediately determine whether or not an item is in stock in the back warehouse or in the back room, behind the register, behind the sales floor, the storage room. They can determine on the computer whether or not the item is in stock. That's because when the item was received, it was scanned in on the receiving dock, and when it's sold, it is scanned out at the cash register. So you update immediately. Now, the purchase of inventory, whether it's periodic or perpetual, will begin with a purchase order followed by an invoice or a bill. And we're going to look at an example of a bill or an invoice in just a minute in Exhibit 5.3. But again, when you look at a purchase system, or if you're thinking about whether or not you're auditing that system or whether you're designing that system as an information systems major, you would understand that you have a purchase order that has to be approved. That gets sent out to your supplier. They will send an invoice that's going to be matched to the goods received. And this, of course, would be backed up by a receiving report. Which, of course, would be digital if you're scanning the goods in. And then, of course, when the goods are received and a receiving report is determined, then you could have the cash payment of that inventory. And of course here, the invoice generates a payable. Or an accounts payable. Now, when you look at this invoice, we're also going to see in a second that it has sales terms. That's going to be $315 net 30. And what this will tell you, and I'll repeat this again when we cover the invoice, that the Smart Touch Learning buying this inventory will get a discount of 3% if they pay the inventory within 15 days. So that's where the terminology comes in. This is a 3% discount if paid within 15 days. If not, the full amount is paid within 30 days. And this is known as a purchase discount, and it will reduce the cost of inventory purchased if it is taken. So it will be a reduction of inventory. So when we look at this invoice, there's a couple of things we need to note. Number one, when you look at the purchase invoice, you'll note that this is the seller. The buyer is Smart Touch. That's the date of the invoice number for record purposes. The credit terms are 315 net 30. So again, this means that there's a 3% discount if paid within 15 days, and if paid within 30 days, when it's due and payable, there is no discount taken. You also notice that there's the quantity that was shipped, there's the unit price and the total, and of course, if it is paid at the time period that you should, it would trigger, obviously, a discount because it's paid within the 15-day period. We'll get to that. Notice there's no shipping, so that's important for us. We'll get to that later. There's no shipping charge and no tax. Now, the important point here is that the company is now receiving an invoice that will trigger an accounts payable. The amount that you're willing to pay, of course, has to be verified, and therefore that's why the quantity would be verified by the people on the receiving end of this, the receiving dock, or anywhere where the shipment comes in. You would not necessarily physically count them, that of course you could, but you would also scan them into inventory to be sure that the amounts are in fact going to be the same as that on the invoice and what you're going to be paying. Notice also that if we look here at the due dates and the amounts, if you pay within the discount period, it's going to be $33,950. If you pay at the end of the 30 days, right, from June 1st to July 1st, so if you pay at the end of the period, then you're going to wind up paying the full $35,000. So let's now start taking a look at the journal entries that would be triggered when the invoice is received. Smart Touch gets the invoice. By the time they receive it, let's say it's June 3rd, it's dated June 1st, they debit merchandise inventory and they credit cash. And that's if they pay it immediately on the date of the transaction. If they decide not to pay it immediately, now we have a purchase that's on account or on credit. And remember, when we have purchases on account or on credit, we're now dealing with accounts payable. That's a trade payable, and we debit merchandise inventory and credit accounts payable. Now, we're going to be using the accounts payable assumption throughout the remainder of this module. Now, you have to remember, of course, that the merchandise inventory account is the same for both purchases in cash and purchases on account. Another point I want to make clear is that we are going to be using a perpetual inventory system. And under a perpetual inventory system, inventory is recorded as it's purchased and when it's sold, and all other adjustments flow directly through the merchandise inventory account. Unlike a periodic system where I said that the inventory only consists of the beginning balance and any purchases are recorded in a separate account. So in this case, merchandise inventory after the purchase, now whether it's cash or credit, whether it's on account, it's the same. And we're going to be using the assumptions again that it is a credit purchase and that it is a perpetual inventory system. So let's just update this for a second. And you should, just to remind you, this is going to be it's June 3rd, let me put it on this side. That the debit goes to merchandise inventory and the credit goes to accounts payable. Now, let's think about transportation charges. And this is going to be the cost of receiving the freight. Merchandise inventory will increase for the cost of freight. This is added to inventory. Now, if we go back and think about the definition of an asset, we know that inventory is an asset. Why is freight an asset? Well, freight is an asset, or it's added to the asset in this case, because it's considered normal and reasonable, and any reasonable costs are added to inventory or any asset. Remember, the cost of an asset is equal to this invoice price plus any reasonable and necessary expenses. Now, whether or not freight should be added depends on the shipping terms, so that you may or may not be responsible for the freight depending on the FOB terms, and the FOB terms basically will tell you who pays the freight. FOB means free on board. Now, if it's FOB shipping point, that means that the goods at that point are placed in the hands of a common carrier, let's say FedEx or United Parcel Service, and the buyer will pay the freight. So if you enter into an agreement where you buy inventory FOB shipping point, then you are responsible for the freight once the goods are handed over to the common carrier. On the other hand, if it's FOB destination, it means that the freight is paid by the seller. Here, it is free on board until it reaches the destination. Free on board means free to you as the buyer. So if we take a look at this exhibit 5.4, we'll see that if it's FOB shipping point, title passes immediately. And incidentally, that should be something you always keep in mind, is that typically there is a link between the passage of title to the buying company and the freight charges, so that when it's FOB shipping point, that is where title passes as soon as the goods are turned over to the common carrier. So let's say that's UPS. As soon as the goods are turned over to the common carrier, there is, number one, legal title. Legal title is passed to the buyer, and the buyer pays the freight. On the other hand, and by the way, of course, the buyer also bears the risk of loss here if it's FOB shipping point. If it's FOB destination, title doesn't pass until the buyer receives the goods. So here, legal title remains with the seller until delivery. Until delivered. And the shipping costs are paid by the seller if it's FOB destination. The buyer on an FOB destination obtains title So the buyer, buyer gets title only on receipt of those goods. So title is only on delivery. So only when it's delivered. So the freight cost incurred by the seller is going to be the freight out. So this is different. Again, if the seller pays the freight, it's considered a delivery expense. and it is a debit to a delivery or a freight expense and a credit to cash. Now, when it's incurred by the selling company, so if the selling company has the freight charges, that's going to be only for the FOB destination. So that you have a debit to delivery expense and a credit to cash for the seller. That is considered to be freight out. And it is an operating expense, and we'll talk about that at another point. When the buyer pays the freight, it's considered freight in, and it is added to the cost of inventory. We debit freight in directly to merchandise inventory. There's no separate freight in account for a perpetual system. And this, of course, would have to be the case. Buyer pays the freight when it's FOB shipping point. FOB shipping point. So, assuming it's FOB shipping point, and assuming that the buyer pays the freight, this is freight in, it becomes part of the cost of inventory. So now we're assuming that $60 was charged for delivery, and under a perpetual system, you debit merchandise inventory and we credit cash. We debit the freight directly to the merchandise inventory account. And a very important point here is that this cash paid has nothing to do with the seller. This is paid to the delivery service, it's paid to UPS. So this cash is paid to the delivery company, not the seller of the inventory. So it does not reduce the accounts payable. So if we look at the T accounts now, the way this is being built up, we've got the original invoice price plus what we consider to be reasonable and necessary to have the inventory in place and ready for its intended use. We add this to the merchandise inventory under the theory that the freight enhances the asset value because it brings the inventory to a location that is needed for sale. So anytime you pay reasonable and necessary expenditures that are needed to have the inventory or any asset in its place and ready for its intended use, it gets capitalized or added to the cost of the asset. So when we add to the cost of the asset, we say we capitalize it as well. So the term capitalization here is important, where we capitalize that account. Now again, freight in is going to be paid to the shipping company, not the seller, so there is no change in accounts payable. So on June 3rd, you had $35,000 credit in accounts payable. And that has not changed because that $60 was not paid to the seller. Now, it's possible that, and it happens to us when we have our own purchases, you may not be satisfied with the merchandise. It could be defective. It could be in inferior quality. It may not be exactly what you ordered. It may not meet your specifications. If that's the case, you can either return the merchandise or keep it for an allowance. And the allowance will reduce the amount that you owe. So it actually, this will happen all the time. You know, someone orders in your family or you ordered yourself, a washing machine or a dishwasher. It comes dented on the side and it doesn't show. You say, listen, I'm not going to send it back. You call up and they give you a credit. They will reduce the price. Now, purchase returns and allowances, whether it's a purchase return or an allowance, is accounted the same way under a perpetual system. Both purchase returns and allowances both purchase returns and allowances will reduce the merchandise inventory directly under a perpetual system. So in this case, let's assume that Smart Touch decides to return. And it's the same thing if there was a $7,000 allowance. So it's the same. If it was an allowance, it reduces your cost of inventory and it reduces what you owe the vendor. There's a debit to accounts payable to reduce the amount you owe to the vendor, and it reduces the amount of merchandise inventory. It lowers the cost of inventory. So, merchandise inventory is now at $28.60 because on June the 4th, you had a return. So, again, original purchase plus freight minus the return or allowance. And I'll just make this a PRA, purchase returns and allowances. And again, this time, we have to be careful because although the freight was paid to a different party, in this case, the allowance or the return on June 4th impacts the payable. So right now, you're going to owe the vendor $2,800. Now, what makes this important, keeping track, and I would always suggest using T accounts. To keep track of the balance is critical because if you need to calculate a discount, which we'll show you in a second, you have to know the amount on which the discount is taken. I've seen many students make tons of mistakes where they forget to take out the allowance and they will record the discount on the gross amount of the invoice. Others add in the amount of the freight, which doesn't belong there. So we have to be very careful. Now, in this case, we look at the credit terms back on the invoice, and if you recall, we know that the credit terms are $315 net $30. This means you're going to get a 3% discount if you pay within 15 days. If not, you would have the full amount paid, due and payable at the end of 1 month. And to summarize this, let's just be sure that the discount percentage is listed first. Then we have a diagonal line. Under that is the 15, which is the discount period. And then the net means that you have to pay it within the total credit period of 30 days. So we have purchase discounts only when the discount is taken within the discount period. If not, there is nothing to account for. So now let's assume that we are going to take this discount. And a couple of things to notice. When the invoice is paid, that is when we take the discount or record the discount. We record the purchase discount directly to merchandise inventory because once again, just as freight increased the cost of inventory, just as a purchase return and allowance reduce the cost of inventory, the discount reduces the cost of inventory. So in this case, the accounts payable balance, as we showed you, was 28. 3% of that is $840. This reduces the cost of inventory if it's paid within the discount period. And remember that this $2,800 was the accounts payable balance. We had a $35,000 credit balance. We owed $35,000 when we bought the inventory. Then we had our purchase return and allowance, which reduces the amount that we owe to $28,000. Okay, so that's going to be the discount. And of course, the discount is computed on the amount for merchandise only. As we said, freight does not impact the discount. Why? Well, you're paying the freight to somebody else. And even if you paid it to the same company, even if the same company shipped the merchandise to you, that freight is not going to be discounted. The freight does not get discounted at all. In many cases, if you get a delivery from Sears and they have their own delivery service, those are independent companies. Those are not owned by Sears itself. So obviously it can't be discounted. Now, let's take a look at accounting if it's paid within the discount period. In this case, what is going to happen is that, again, we know that it reduces the cost of inventory, but the key is that the amount that is due, the net amount that is due in this case, is going to be $27,160. And how do we get that? Well, if we take the accounts payable balance, that was 28. And then we have the discount that we computed as 840. The net amount due to the supplier is $27,160. That's the amount of cash that we owe. Now, to record this, we're going to debit accounts payable for the full amount paid on the 15th, which is within the discount period. So when we debit accounts payable, we had $35,000 for the invoice price. We had a $7,000 return or an allowance. The balance is 28. And now when we debit accounts payable for paying it off, it reduces the balance to 0. So accounts payable now goes to 0 as it is paid off. And of course, the discount reduces the cost of inventory by $840. And right now, the inventory account is equal to 35 original acquisition price plus the freight minus the return and minus the purchase discount. So the inventory account will reflect the net results of all of the transactions during the period. So we've got a purchase, we have freight in, we have the purchase, return, and allowance, or allowance, they are accounted for the same way, and we've got the purchase discount. So we add the freight, and we subtract the purchase, return, and allowance, and we subtract the purchase discount.